Ladies and gentlemen, good day and welcome to the Shalby Q3 FY23 earnings conference call hosted by Elara Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abdul Qadir Puranwala from Elara Securities Private Limited. Thank you, and over to you, sir.
Well, thank you, operator. Good afternoon, everyone, and we welcome all the participants to the Shalby Limited Q3 FY23 earnings call hosted by Elara Securities. Today we have with us the senior management representatives from Shalby. We will start with the opening remarks from Mr. Sushovan Das Gupta, Vice Chairman and Global President, and Mr. Parag Agarwal, Chief Business Officer. And followed by that, we'll have a discussion on financial performance by Mr. Venkat Pasuraman, Chief Financial Officer. With that, we'll open the floor for Q&A for all the participants. And I will now hand over the call to Mr. Punish Maheshwari for an important disclosures and disclaimers regarding any forward-looking statements that may be made in today's call. Over to you, Punish.
Thanks, Abdul. Good afternoon, everyone. Our earnings presentation is uploaded on the stock exchange website and our company website, shalby.org. We do hope you have already had the opportunity to go through the presentation. Please note that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. Kindly refer to slide number 36 of the investor presentation for a detailed disclaimer. Now, I would like to hand over the call to Mr. Sushovan Das Gupta, Vice Chairman and Global President, for his opening remarks. Thank you, and over to you, sir.
Thank you, Puneet, and very good afternoon, everyone. And a warm welcome to all on our Shalby Limited's third quarter and 9 months full year 2023 earnings call. All of us at Shalby sincerely hope that you, your families, and your friends stay happy, safe, and healthy in this new year 2023. I would first like to take a moment to introduce Mr. Parag Agarwal, who has joined our Shalby Group as Chief Business Officer in November 2022. Parag is an alumnus of IIM Ahmedabad and IIT BHU, and brings with him over 20 years of rich strategic experience across various industries and functions. Prior to Shalby, he was heading up the sales and service and vertical at India Mart as Senior Vice President and took the company public. And prior to India Mart, he worked at senior leadership positions at various companies. We are delighted to have such an experienced and successful professional like Parag on board at Shalby. At Shalby, Parag will be spearheading our high-potential, high-growth SOCE franchise verticals and many other new strategic opportunities that we at Shalby are looking forward to. Now on to our quarterly achievements. Our hospital business continued to show consistent performance in all key operational and financial parameters in the last quarter on a year-on-year basis, delivering high double-digit growth in the key matrices of inpatient counts, which includes daycare, and surgery counts, growing 15% and 19% respectively. Hospital revenue and EBITDA also grew by 17% and 23.5% in third quarter on a year-on-year basis. Such excellent performances are a result of the continuous all-round efforts taken by Shalby through various business development initiatives throughout the country, thereby improving our occupied beds to 544 beds in this quarter 3 from 513 beds in the same quarter of last year. Multi-specialty hospitals provide immense confidence to patients when they operate several critical and complicated clinical procedures with continued success. At Shalby, we continue to show clinical excellence by performing critical surgeries across many of our units. For examples, I can cite here our 6-kidney transplant at SG and Indore unit of Shalby, and the successful replacement of a badly damaged mitral valve and tricuspid valve in a senior citizen patient at Shalby Naroda. I'm happy to communicate that we have conducted more than 270 healthcare camps and provided 105 healthcare talks across various locations and consulted more than 14,000 patients in this quarter. It is very encouraging for us at Shalby to see numerous words of praise and positive testimonials flowing in every day from both our national and international patients on how we are making a positive impact in their lives. I'm also very glad to share that Google, through its arm YouTube, has partnered with Shalby to create credible video contents on various health conditions as a part of healthcare education and awareness programs. I'm also very excited about our growing home care services, which grew by 42% year-on-year with revenues of rupees 2.65 crores and patient count of over 7,000 in quarter 3. Additionally, our international revenue grew by more than 50% year-on-year with revenue of rupees 2.5 crores, wherein majority of the patients came from East African countries in the last quarter. We are actively seeking out for more associations in African and UAE markets to accelerate our growth further. Shalby also takes immense pride in nurturing young talent through Shalby Academy with more than 1,900 students registered in the various healthcare programs during 9 months of 2023. We also felt satisfied providing various job offers to these students across our hospitals. Our knee and hip implant manufacturing business under Shalby Advanced Technologies, or SAT or SAT as we call it, in California, US, has made some steady progress during the last quarter and 9 months of full year 23, clocking revenues of rupees 23 crores in the last quarter, of which sales in the US and India contributed 60% and 40% respectively. Our revenues of over 73 crores at the end of 9 months positions us well to finish the year around rupees 100 crore sales with positive EBITDA as per a commitment given at the beginning of the year. Our US sales customer mix from retail and wholesale remained at 60% and 40% respectively in quarter 3 full year 23, which helps us in getting better profitability mix. With all the efforts to improve implant production, we are happy to announce that we are now producing average 4,500 components per month from the 3,000 components that we produced during the first quarter of this year and versus 2,100 components per month same time last year. And we are very soon expecting to reach 5,000 plus components production per month soon. We have strengthened our senior leadership team in the US by onboarding 2 very senior talent in the last quarter. Mr. Garrett Kiesler has joined us as President and Chief Operating Officer from Smith & Nephew, and Dr. Jafet Noah has joined us as Vice President for Quality Assurance and Regulatory Affairs. Both of them are highly successful and experienced leaders, and we expect them to bolster our leadership drive for accelerated profitable growth. We successfully navigated through our ISO 13485 audit for Shalby Advanced Technologies in November 2022. And I'm glad to announce that we received the certification in hand yesterday itself, a proud testament to the high standards of quality we hold ourselves accountable to. We are receiving very positive responses from the consumption of our Shalby conceptual implants from our surgeons at our Shalby hospitals. And I'm very glad to mention that we have now launched such high-quality knee and hip implants to other surgeons and hospital groups in India as per our plan, and initial response has been supremely encouraging. We will soon be receiving registration approvals to launch our implant products in Indonesia, Argentina, and Colombia in this quarter. With all these key strategies, our team is extremely committed on flawless execution of such strategies with the right people and leadership in place. Shalby is very well poised to further improve occupancies and continue to deliver double-digit growth in the hospital business with sustainable profits and to hit the coveted milestone of rupees 100 crore sales and the EBITDA positive in our implant business in this fiscal year. All this, in turn, will help create sustainable value for all stakeholders at Shalby Limited. Now, let me hand over to Parag to discuss our SOCE quarterly performance. Over to you, Parag.
Thank you so much, Shubhan, for your kind introduction and sharing quarterly developments on hospital and implant business. A very good afternoon, everyone. let me discuss the quarterly developments for SOC vertical. Our endeavor to expand our Shalby footprint through the asset-light model strategy is continuing at full speed. I'm happy to inform that our Lucknow SOC unit has been fully operationalized from November 2022, and Gwalior SOC unit will be entirely operationalized soon. Let me tell you, Lucknow is under Shalby operated and Gwalior should be under Shalby managed model. I'm also glad to inform that we have signed an MOU with Aurangabad under SOC franchisee. We are in continuous process of taking over all operations in our brand name with whom we have signed MOU. We are optimistic to see the good developments come to fulfillment in the coming quarters of this financial year. Moreover, our focus remains on capitalizing our expertise and excellence in orthopedics to have 50 Shalby franchise hospitals across India within the next 3 years. Now, I would like to hand over to Mr. Venkat, CFO of Shalby Limited, to discuss Shalby's quarterly performance in more detail.
Thank you, Parag. Good afternoon, everyone. I'll now take the opportunity to walk you through the financial performance of the company for the third quarter of FY23. First, I'll be running you through the standalone performance of the hospital chain, and then I'll be coming to the consolidated financial performance. On a standalone basis, the revenues for Shalby grew by 17% year-on-year to INR 179 crores. EBITDA grew by 23% to 39 crores. PBT grew by 33% to 29 crores, and PAT grew by 52% to 19 crores. The ARPOB and ALOS were recorded at INR 36,491 and 3.7 days respectively in Q3 FY23, vis-a-vis 30,049 rupees and 4.02 days in the same quarter previous year. Our core specialties such as arthroplasty, oncology, cardiac science, orthopedic, clinic, critical care, and general medicine contributed 85% of the revenues in Q3 FY23. We continue to maintain ROC at 16 to 17% as on December 22 from our hospital business. At the group level, on a year-on-year basis, the revenue grew by 25% to INR 207 crores, EBITDA grew by 23% to INR 38 crores, PAT grew by 19% to INR 15.4 crores. Please note, all my references for the previous year PBT and EBITDA are prior to an extraordinary expense towards the disposal of indoor land of INR 4.44 crores, and the PAT is after the said item. Coming to the US implant business, the monthly revenues have reached the $1 million mark in the current quarter. The entity is near breakeven in Q3 23. We achieved a revenue of 22.8 crores in Q3 against 9 crores in Q3 22. We earned an EBITDA of negative 30 lakhs in the current quarter against a positive EBITDA of 28 lakhs in the same quarter previous year. With significant ramping up of operations, we are expecting a strong turnaround by the end of FY23. We have closed the year with a net cash balance of 150 crores on a standalone basis and INR 38 crores on a group level. Thank you very much. We now open to any questions which you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants using a speakerphone are requested to please pick up your handset while asking a question. This is required to ensure optimum use of audio quality on the call. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Dhananjay Jain from Brescon. Please go ahead, sir.
Sir, I wanted to ask regarding the capacity we have of the beds. We currently have approx 1,200 beds and we can go till 2,000 beds more. So how are we planning to upgrade this capacity? How are we trying to achieve that utilization of increase in the bed capacity? How we will optimize the asset which we have built till now? Because how I understand, the
our primary service is orthopedic, which requires very less time compared to other kind of surgeries, say cardiac or oncology, where average length of stay is around 5 to 10 days, whereas we have around 2 to 3 days in which we can complete the surgery. That is my first question. Another question is, sir, Shalby as a brand is recognized by name of Dr. Vikram sir. So how we will build the local doctors, because it's a micro market where name of each doctor will matter. So how we will build those local hospitals which we are acquiring and name building for those hospitals. Another one is various competition market their services using robotics for the orthopedic. So in long term, how we will counter that, because that is one more thing. These are my 3 questions.
Sure. Thank you. With regards to your first question, we are clocking occupancies, in the months ranging between 500 to 700 beds, right? And this is the nighttime occupancy that we show you. So the daytime occupancy is often 15% higher than that. Now, for this kind of occupancy level, we have 1,260 beds operational as we talk, which is sufficient to kind of handle this kind of patient flow and also a 15 to 20% growth at any point of time, right? We have always maintained that the bed capacity of the group is in excess of 2,000 beds, and as and when the occupancy goes up, which it has grown at 18 to 20% over the last 5 years, we will continue to add the beds. So about 2 years ago, we had about 1,000 bed operational. Today, we have 1,260 beds. So as and when the occupancy ramps up, which it is growing, as I said, at 18 to 20%, we will be operationalizing the other beds. The good part is that we do not need to add, a lot of capital expenditure to operationalize the bed from 1,260 to 2,000. The estimated budget to kind of get there is close to 15 crores, which is a very small amount in terms of, the capital expenditure required. So that is the answer to your first one. With regards to your second one, we have come a long way because, of course, this company is founded and promoted by Dr. Shah, and, he is the head for the orthopedic department. Having said that, as we talk today, about 35 to 40% of the work we are doing is orthopedics. The balance comes in from other specialties, where other super specialist doctors have a role to play. The other part is that within the orthopedic space, his direct contribution in terms of the surgeries that he does is about 15 to 20% of the 35 to 40%. So it would be about 10 to 15% would be his direct contribution, which means that, this occupancy of 550 to 700 beds that we talk about say 10 to 15% of the beds would be occupied to, his patients, and the balance would be coming in from all the other specialist doctors, at all the locations. You also, will appreciate that we are geographically quite spread out across 5 states as we talk, and, Dr. Shah cannot be everywhere. So, we have very good doctors across all specialties, including orthopedics, in all these locations. And all of these orthopedic surgeons which perform knee and hip replacements and other orthopedic surgeries are trained under him for several years before they actually perform these surgeries across all our units. The third one I think you asked about is with regards to robotics. That's a good one, and we have in fact said, Dr. Shah has said it multiple times in the past as well, that whenever a surgery is done and the cut is large enough for the naked eye to kind of see and perform the surgery, basically at that point of time you do not require a robot to do the surgery. So in fact we have him today in the call, and he'll be happy to kind of take you through that question.
Dr. Vikram Shah.
robotics.
Excuse me. Sorry to interrupt, sir. The line is not very clear at the moment, sir.
Now is it clear?
Yes, this is much better, sir.
Robotics are there in orthopedics since last 20 years. It started as a navigation, and generation 1, 2, 3, 4, 5, this is the 5th generation. And most of the leading surgeons of the world have thrown it out of the operation theater. I will tell you the reason. Computer or a robot can work in a given set of rules. If you fit the rules, it will work fine. Anything outside rule, it doesn't work. I will tell you, while you have Boeing and Airbus flying at 32,000 feet, there are hundreds of crores rupee plane, and those planes have computer and robot sitting there, which is flying the plane at 32,000 feet. But taking off from the ground and coming to the ground, 2 pilots are required so that they can bring down the plane safely. The reason is number of variables are lost when you are taking off, you are coming down on the ground. At 32,000 feet, there are no variables. So computer can work nicely and it can fly the plane. Other thing is, in a game of chess, there are 8 into 8 boxes, and then king, queen, rook. They have set rules to play. In this game, computer will defeat human being because it is fixed game. As far as knee replacement or hip replacement are concerned, there is no fixed game. No two knee are same. Even same patient, right and left knee are separate. So people do come to me, all these multinationals, big companies, they want to put it free at my place because of my volume of work, because we are the biggest in the whole world, not in India. They want to put free at my place. I am not letting them put because I am doing service to another 10,000 orthopedic surgeons. So if I put it here free, they have to buy it. I am doing social service by not letting them put this machine free in my operation theater. And what these company guys come and tell us that this is a great marketing tool. I had been telling them that if you cannot sell your surgery, if you cannot sell your skill, this machine cannot save you. Thank you.
So my question was actually on the so one is we are specialist, or suppose I am researching, so I am aware about this fact. But as mass, they get biased very easily, or they get influenced very easily by these marketing tactics, and this ends up eating our business. So how are we educating the mass? That is one question. Apart from this, 2 other questions which I have is, one regarding we are having this franchisee model. Now we are planning to open around 50 hospitals in current 3 to 5 years. So what will be split of those hospitals in terms of say managed, and what will be the shall be operated percentage? Where operated would be, we will be sharing out the revenue. So in terms of the split of those 50, and what is the potential in terms of number, like say 300 crore, 400 crore, 500 crore. I recollect you had guided earlier in earlier calls it would be around 600 approx 600 crores. So
I will first answer your robot related question, and then rest of the questions will be answered by the management because I don't look after general management. As far as the robot is concerned, I am reiterating again that no machine can market hospitals. Those hospital CEOs and CEOs who believe that this machine we are bringing of 12 crores and that will save our next year, that is their big mistake. If that machine is useful, first perfectly fine. If it is going to make any difference in the result, perfectly fine. Otherwise, in orthopedic surgery, robots have no place to work at all. Neither marketing nor surgery, both. And rest management will answer you.
So we are also joined by Mr. Parag Agarwal,
who heads the SOC business. So he'll take the next question. So, to your question that how will the spread be between the Shalby operated and Shalby managed over the next 3 years as we develop, I think it's a bit premature to, give an exact or a guidance on what will be the percentage share. Our endeavor is that when we enter a market, we look at the size of the market, the franchisee we are tying up with, and accordingly develop that particular model. So far, we have, for the 4 units we have operational, it's a 50-50 split. And as we develop and as we learn with this business, things will become a little more clear in terms of what will be the actual spread between the two.
Okay, thank you, sir. And few more questions which I have is, one is we will open.
I would request you to rejoin the queue if you have any further questions.
Sure.
Yeah. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, we request you to limit your questions to 2 per participant. The next question is from the line of H.C. Daga from Daga Associates. Please go ahead, sir.
Yeah, good afternoon. Thank you very much for giving me the opportunity. Just in a nutshell, I would like to know that what is your vision for the next 3 years? If you can just give us some guidance on about the revenue and the EBITDA growth and the numbers, if it is possible. Okay, thank you.
So, as such, we are not giving any guidance, but see, the hospital business, we expect it to grow at 20% for the next 3 years from the current level. And for the implant business, I think Mr. Das Gupta will be happy to share, what is the vision for the company. And, I think for the SOC business, again, that is a huge potential. It's a third vertical where, we are expecting the business to grow in a big way as you know that we have expected, we see more than 50 operational franchises over the next 5 years. However, it is very early to comment on what kind of numbers, we'll be projecting for that. So, as and when, we'll be seeing more hospitals operational, we'll be able to give a much better guidance. But I think for the implant business, Mr. Das Gupta will be happy to share it. Over to you, sir.
Yeah, thank you, Shana, and thank you, Mr. Daga, for the question. Just to give you a context of where we are on the implant business, when we took over the implant, we acquired the assets of Consensus Orthopedics. That was in May 2021. The first thing that we did, we looked at the situation, and on that basis, we developed a 5-year plan, not a 3-year plan or a 5-year plan. Obviously, when we do the 5-year plan, we broke it down by years. So when we looked at the 5-year plan, we looked at where we are in terms of our market share, where we are in terms of our current products, what would be a future product pipeline, what could be, where is the presence in geography in the U.S. and outside the U.S. All this put together, when we looked at it, we said that we can do this business and grow this business to $100 million in 5 years' time. So our first plan from a revenue perspective to your question, we want to make it a $100 million company in 5 years' time. And then we broke it up by revenue. So our plan was to make it a $12 to $13 million at the end of this fiscal year, which is 100 crores, as I said earlier, and we are well in that area of 100 crores. We also wanted to make it profitable. And if you understand the orthopedic implant business, it involves a lot of inventory, a lot of capital expenditure, and a lot of, I would say, resilience and patience to make this happen. But in 22 months' time, we are pretty certain that we would be EBITDA positive when we end this fiscal year. So that means we are getting into a profitable situation, and we would be very healthily profitable when we do that $100 million business. The other aspect that we looked at is how we could be able to use the manufacturing capacity and the potential that we have. When we took over the plant, it was manufacturing only 300 to 400 parts per month. So earlier last year, it was manufacturing 1,000 to 1,200. As I said, the last quarter of the same quarter of last year, it was 2,100. We have doubled it. We are doing 4,500. And why we are doing this, again, when we produce more, our costs get distributed, so the cost of manufacturing comes down. And when the cost of manufacturing comes down, we can sell not only in the U.S. but to many parts of the world and make healthy profits. So that was the third way. And the last way to your question is obviously comes product and people. And we looked at where our product pipeline is today. We had deficiency in certain product lines. We have been able to plug most, if not all. So we have launched our unicondylar knee, which according to Dr. Shah, he's done close to 150,000 implants, the highest in the world. And if a person like him can say that this is one of the best unicondylar knees that he's seen and used, I am very confident that it will take the world by storm. We have done limited market release with our designer surgeon in the U.S., and we expect to launch it full-fledged from the end of this quarter. And then we would be spreading it across to the world. And then the last one is we also, in the verge, within the next 2 quarters, launching a very new knee. And that will also give us a lot of impetus over. And finally, as we said, is people. We are ensuring that we have the best leadership team in place. So we have done a churn in leadership. We waited for some time, looked at the situation, and today we have a very competent leader. As I said, Garrett Keesley, whom we got from Smith & Nephew. We have a fantastic quality and regulatory person. We have an outstanding supply chain person. These are some of the basic tenets of running the orthopedic business successfully. So we are very well poised, Mr. Daga, to your question of beating $100 million in 5 years' time from a revenue perspective and becoming a very, very profitable company for Shalby.
Thank you. Wish you all the best.
Thank you, sir.
Thank you.
The next question is from the line of Ruchita Kadge from iWealth. Please go ahead.
Hello, sir.
Hello.
A very good...
Ms.
Hello.
Kadge, your volume is a little low. If you could please speak closer to the mic.
Yeah, now can you hear me?
It's a little better.
Yeah.
Yes.
So, good evening. So my question was on the implant business. So, sir, if you could give a breakup of the variable and the fixed cost for this business.
So it's difficult to really comment on the breakup of the variable cost and the fixed cost, but I'll leave it to Venkat to be able to give you. But let me give you some parameters. So when you look at the fixed cost is anything that is getting distributed outside of what is happening in the shop floor. Variable costs are basically costs which is inside the shop floor, which includes a lot of consumables, as well as the employees that come in and do the shop. The good news that I can tell you is that we have been able to reduce and bring down our fixed and variable cost by a whopping 35% over this period, over the same quarter. So quarter 3 of last year, whatever the fixed and variable costs were, we've been able to bring down a whopping 35%. And then the other cost that is big for us is raw materials, right? I mean, the raw materials, we've been able to bring a significant reduction in cost. Close to 50% of reduction has been made in raw material procurement costs. So that you can understand, and that is really helping us to reduce our cost of goods sold, and that will help us to get into the positive EBITDA and later before tax as well. Venkat, would you like to add the fixed and variable component to the question that she asked?
So the variable costs are in the range. So if we want to give an indication of the variable costs, the contribution level for this for the implant business in US is in the range of 40 to 45%, and then we have fixed costs in the range of $4.5 lakh a month. So that is indicatively the.
She's asking for the percentage.
Yeah, no. So I think what is important to note here is really that we have been able to bring the costs down per component very, very significantly. So, we've been able to bring it down in the range of 35 to 50% of what it was. And we are on the right trajectory. And as Mr. Dasgupta mentioned, the moment we achieve the scale of 5,000 components a month, we will be very well in line with, our projected numbers and, where we want to see the company over the next 12 to 18 months. Also, Dr. Shah would like to add some flavor.
The most important part in implant business, in my opinion, is your time to market. When we took over this company, we took over 50 patents. And because we have 50 patents, we are able to almost turn around this company in 20 months. And we are able to push these products in India, all over America, and also in Japan. And very soon, Mr. Dasgupta is going to launch it in Indonesia and Korea also. So, most important part is patents, because if you don't have patents, if you don't have products, to develop this patent and have it in US FDA, it takes 3 to 5 years, the entire process. So, we are 3 to 5 years ahead because we have 50 patents. That is the most important part in this. Margins of United States, margins of Japan are fabulous. Indian margins and Indonesian margins are on the lower side, but then the volume is very high.
Hello, sir.
Yes.
Yes. So, how much is the fixed cost, did you say?
So, I think what Dr. Shah suggested, and I will repeat, is that, what is important is that, 3 to 5 years is the time taken usually for a startup company to kind of build these kind of products and, kind of get them accepted by US FDA, get the plant approved and, get the designs approved in all these countries. So what he's trying to say is that, we basically are on a platform where we have everything ready. And, in fact, we received our India approvals also in February last year. So basically, we are in the right trajectory, and we have also managed, on the other side, we've managed to bring the costs down for, the implants by about 35 to 50%, depending on the product. And it will further come down as the production goes up. At the moment, we are busy building an inventory that is required, which is sufficient to kind of penetrate some of these newer markets that we have planned to penetrate. I hope that answers the question.
Sir, I'm a little, confused about the fixed cost component, because that is something that, I would like to know.
Yeah, at the moment we are not sharing, all these details, specific details on the fixed cost, but maybe we can take it offline, madam.
Sure, not a problem. And this this pharmacy business that you have, or the pharmaceuticals, so how much percentage does that contribute to your profit?
So all our hospitals have, an inpatient pharmacy and outpatient pharmacy, and, all the revenues and the earnings that you see for these pharmacies are all clubbed into the hospital business.
Okay. And also, if I can ask another question. In the hospital business, sir, you've mentioned that 20% growth you are expecting. So is this every year, or at the end of the third year is what you're expecting from the current level?
Yeah, see, in this year we are looking at doing around 725 to 750 crore kind of revenue in the hospital business, right? What we can do in the existing capacity without adding any more beds, like I said, 15 crores is the capex that is required, we will be able to do about 1,400 crores of revenue in this existing capacity. So when I say 20%, I mean 20% year on year for the next 4 years is what we can do in the existing capacity. Beyond this, we have already announced 2 projects which will be adding, further revenues over and above this. So that is, I hope that clarifies the question.
Okay, sir. And just one more question to what the previous participant was asking on that line. The implant business, as you said, is a $100 million revenue business which you have estimated in the next 5 years. So out of this, around $12 million you will be able to achieve in this year itself. So the remaining, $85 million. So how will that be distributed in the coming 3-4 years? If you can give some light.
So basically, what we are expecting that, as Dr. Shah alluded earlier, that when our prices in the U.S. and Japan are much higher, so obviously when you get a much more profits out of U.S. and Japan, but the other markets, which is India or Indonesia, some of the Southeast Asian markets, we plan to launch in some of the Middle East and Africa markets in the future, in Latin America, which we plan to do in Argentina, Colombia, and Venezuela. So these markets, the prices are low because of several reasons, market forces or where it's regulatory from the government. So our plan is to really look at volumes in these places. So when you look at from a revenue perspective, we expect that 100 million out of that 100 million, 60 million will come out of the U.S. and 40 million will be coming from the rest of the world. However, from a volume perspective, we expect more than 60% coming out from the rest of the world and 40% or less coming from the U.S. That's our plan. Does it answer your question?
No, sir. So
Thank
I
you.
would like to again speak on that. 12 million is already achieved in the past 2 years, if we see. So the plan that you've said of 5 years that you'll achieve $100 million, so only 3 years are remaining for it. So are you expecting 90?
Yeah, no. Yes. Last year, when you look at 12 million is a fiscal year. So from April 22 to March 23, sales will be $12 million. Okay? Now,
yes.
Previous year, when we took over the company, it was much lower. It was around $4 million or so from April 21 to March 22. Similarly, from March 23 to April 24, we plan to double our sales from 12 million. So it will be, say, 25 or 26 or $27 million. Like this. So in that way, in 5 years' time, that fiscal year, at 5 years, we will be landing at $100 million sales. Does it help you?
From here onwards.
Correct. It's not a progressive addition to that. It's basically every fiscal year we will be increasing our. So after 5 years, on the 6th year, we expect that the sale of that fiscal year will be $100 million, out of which $60 million will be contributed by the U.S. and $40 million will be contributed by the rest of the U.S. and a lot of these products will be driven through new products which we are coming in the next few quarters and in the following years as well.
That is by FY27 you're saying, right? $100 million.
Correct, which is April 27 to March 28. Yeah, that's right.
Thank you. Ms. Katke, if you have any further questions, we request you to please rejoin the queue. The next question is from the line of Bhavya Gandhi from Dalal and Broacha Stock Broking. Please go ahead.
Yeah, am I audible?
Yes, you are audible, sir. You can go ahead.
Yeah, yes. Thank you for the opportunity. So I just wanted to understand about the occupancy rate, because what are the levers to increase our occupancy? Because COVID is already over, but I don't see a very big jump because optional surgeries have already started. So what are the levers to increase the occupancy in our case, and where can it peak out?
See, so I think the way to look at it is that we have 3 units which are already performing at the most optimum level. One is SG in Ahmedabad, one is Indore in MP, and one is Jaipur in Rajasthan, right? Now, if you look at some of